Johnny Roberts, we're back for another episode of your podcast. How are you today, sir?
Doing great, Mike. How are you doing?
I'm fantastic. I'm just excited to get into this last episode of this mini series we've been doing with tax expert Heither Schreiber. And I know you got a really common conversation that we hear all the time that you want you and Heather to talk about and let her really explain it. So I'm just going to let you take it away.
So great having you again, Heather. This is awesome. You really help out our team with so many great benefits, helping out our clients and everything. And so this is it. One of the biggest things we got, Johnny, I'm retired. I've got all this money in an IRA. I'm 63, 64, could be 66 years old. I'm scared to death about my taxes. What can I do? There's things out there, Heather, we know called Roth conversions that are out there that some people can get nervous about. Maybe it's beneficial, maybe it's not. But tell us about the Roth conversion concept. Why is it good? Um, and why could it be possibly negative? I mean, I think it's a great opportunity for people to definitely keep some of their money in the right situations for sure. But tell us your thoughts on that, Heather, about the Roth conversions and kind of what you think.
Yeah. So yeah, it's a common question. We talked about in one of the segments about diversity. What does diversifying mean? And we usually think about it as investment diversity. But I look at it, because I'm a tax nerd, as tax diversity. When I'm looking at assets, I'm already thinking, like, if I look at a large pre-tax 401k or IRA, I'm already calculating in my head the future required minimum distribution amount, because I know that's going to be taxable, and how will that have a ripple effect. So Roth conversions, a lot of the reason that people are thinking about them and asking you, Johnny, should I do this or not, is because they're concerned about all the things we're talking about, the ripple effect it can have. We talked about, if we're supplementing Social Security with a traditional IRA or a traditional 401k model, then that can have a ripple effect, and likely will, on the amount of Social Security benefits they keep, because of the way the calculation is done to determine how much of Social Security is taxable versus taking a tax-free qualifying Roth distribution that wouldn't affect that at all. That doesn't go into the calculation for determining Social Security taxability. So what's the benefit of it? I mean, the benefit of it is that you're going to keep more of your income. If you do a conversion, then eventually you're sort of putting more of your nest egg over into the potentially tax-free side. I say potentially because we talked in the last segment about you got to hold your horses. You got to hold it for 5 years and meet an event, which is normally going to be age 59 and a half, for all of that tax deferred gain to be tax-free. That's what you're getting to. That's what we're trying to get. That's the golden egg. And so, to convert, though, what does that usually mean? I'm going to have to pay the piper now, because what I'm usually doing is I'm converting some of my pre-tax balance, that large chunk or maybe a smaller chunk of my IRA, to get it to that side, so that, I'm going to pay taxes on whatever I convert. I can do conversions. We talked in the last segment about eligibility for Roth contributions comes by way of looking at how you file your taxes and what your adjusted gross income is. That's how you determine it. With Roth conversions, there's no limit. Anybody can convert. Okay. Anybody can convert and any amount they want. The thing is, they have to pay taxes on the amount of pre-tax retirement accounts they convert, right? So if I'm going to convert $20,000 in 2024 for my traditional IRA, well, then I'm going to have to add $20,000 of ordinary income, to my tax burden. But the idea is, okay, I'm maybe going to convert a little bit at a time every year. And I would work with my tax advisor to figure out how much can I afford with not killing myself, because the point is you got to pay taxes on it. Ideally, the question I get is, well, can I pay taxes from the amount I'm converting? Ideally, you want to pay taxes from an outside source, because you get more of the money to work for you right away, right? But some
Right.
people say, well, I'm going to withhold taxes from my traditional IRA to pay the taxes. That's okay, but be careful. If you do that and you're under 59 and a half, guess what's going to happen? If you withhold, say, 10% to pay the taxes on a $20,000 conversion, well, that $2,000 that you had withheld for tax purposes is also going to be subject to a penalty, because you were under 59 and a half. So be careful about that. Johnny can help you with that. But conversions, a good idea, especially if you're doing it a little at a time. I also recommend that if you're going to do them, you can't undo a Roth conversion, you used to be able to undo it. It was called recharacterization. So if the market tanked after you did one at a high level, you could say, oopsie, I don't want to do that, change my mind. Now you can't. So I usually suggest if you're considering a Roth conversion, do it toward the end of the year when you kind of know where your
Exactly.
taxes are going to hit, right? And you can, I call it burping the bracket. You might say, okay, what can I do to keep me in the same tax bracket I'm in without going from 12% to 22%, for example? Do things like that. What are the benefits? Obviously, you're getting more on that side of the fence versus traditional. So when you start to draw down in retirement, you have more predictability in terms of not worrying about what taxes are then. There's no RM required minimum distributions from Roth, so you're not forced to start taking it out. We talked, Michael mentioned legacy planning. I'm thinking legacy from the standpoint of if you want to leave a more tax efficient vehicle to your kids and after you die, well, that's the way to do it, because under the new rules for stretch IRAs, they're mostly gone for adult children. They usually have to they accelerate their post-death distributions to a 10-year period. Now, most of these adult children that inherit retirement accounts are going to be in their prime earnings year. So if they inherit a Roth, they're going to get that tax-free versus a traditional IRA that they're going to have to pay taxes on within a 10-year period most of the time. There's a few exceptions, but most of the time, adult, healthy, grown children are paying taxes in over a 10-year period at max. So those are good reasons. Reasons to be mindful of doing a Roth conversion, and you mentioned in your 60s, is you don't want to do so much that it puts you in a precarious tax situation at year end or come April when you're like, I did this and now I'm paying buku and I'm not prepared for it. So always work with a tax advisor. But the other ripple effect that people don't think about is if you're on Social Security and you do a Roth conversion, well, you're going to have to, that's taxable income that year you do it. So it might cause your Social Security to be taxable or create a higher tax burden federally on that income. Most states have, exclude it or in some form or fashion give it preferential treatment. So check with your state. The other thing that it can do is if you're doing it in any year or any year that you're on Medicare premiums are based on your modified adjusted gross income 2 years prior to the current year. So for example, people that are on Medicare in 2024, Social Security is determining what their Medicare premiums are based upon their 2022 AGI. So if I had a huge Roth conversion in 2022 that bumped me over, say I'm a single person that bumped me over $103,000 of income, my AGI, well then guess what? Aunt Irma is going to come pay me a visit. That's the income related monthly adjustment amount. And they would send me a letter that says, guess what? Congratulations, your income in 2022, because of that Roth conversion, bumped you over the standard Part B premium of $174.70. Now you're going to pay XYZ more for a 12-month period. So I always recommend, because Roth conversions are taxable in the year that they're done, you have to be careful if you're going to, when you're on Medicare, always look in 2 years before every single year. What's my income going to look like? So if I'm going to do a Roth conversion, work with your tax advisor, make sure that they understand how that works and say, okay, let's stay under the radar. If we're going to do them, let's do enough, but let's try to stay below those thresholds if we can to avoid paying higher Medicare premiums for a 12-month period. Now it's a rolling 12. So every year, if you have to pay it for 1 year, it goes away the following if your AGI goes down to normal levels. But those are the things that I always warn people about from a tax standpoint.
Yeah, every individual situation is different, of course, but that IRMA, we always try to watch tax brackets. We want to try to help our clients, see where we're going to be at, right? Because right now the taxes are lowest level they've been in years, right? Heather, these brackets are,
Yes,
I
they're
think
on
you can do it.
sale through the end of 2025. They're on sale. And then to come 2026, we're going back up
Supposed
to
to go back up.
39.6 versus the 37 we have now. So tax rates are slated to go back up. Those rates will sunset or expire at the end of 2025 unless something crazy happens. And who knows, in this environment, who knows what could happen, but that's what's supposed to happen.
And I think if we're talking to a client properly, what we try to say is whatever money you want to convert to a Roth is down the road money, right? You don't want to think about this money for 5 years or, what I'm saying?
That's
So at
right.
least 5
That's
years.
right.
So if you're going to do a Roth, you're 64, you're retired or whatever, you want to be going to do Roth conversion. every year. That's down the road money. I don't need this money to buy milk next year. I don't need this money to,
Right.
travel to Florida or whatever. I've got other funds over here for that. So money with a purpose, and you could take money that you have. The purpose is to make this money tax free, right?
Exactly.
And that's what we
Exactly.
try to help teach people to do is because it can be hugely beneficial down the road. And it really doesn't matter necessarily, Heather, whether it's early 60s, late, it's all the same mindset, money with a purpose and managing your tax brackets and realizing what the rules and guidelines are because taxes, most people are living longer, like you said. And generally, if you're doing it in those age brackets, you're going to save money long-term on taxes.
That's right.
You
I mean,
just
it's,
are,
yeah, and see, I'm a big advocate of what I call serial mini conversions. Do a little bit at a time.
Absolutely.
Do it. Do a little bit at a time. It doesn't hurt as bad, but do a little bit at a time.
Absolutely.
So I think that you don't have to do one big fell swoop. You can do a little bit at a time as you can stomach it, because you obviously have to pay taxes while you do it. But I'm telling you, the more you can diversify, you can move money from the pre-tax bucket to the after-tax or the tax-free bucket. And you're right, Johnny, you want this money not to be money that you think, oh, I might have to tap into it in the next 5 years or before I'm 59 and a half. It's not the money for a Roth conversion. You don't want to do that. It's a hold and stay. I want to convert it. I'm going to hold it. I have discipline, but I'm going to let it sit here because the whole idea is that it's going to grow tax deferred. That's going to build up. And then I'm going to have taken advantage of all that inside gain that's never taxed. So the earlier someone can do it, the better. I mean, even before retirement, if they can, talk to their advisor about it. They've got old 401k money sitting in an IRA that they have access to. Hey, do I have any room in this tax bracket to just do a little bit of a conversion? Start doing it. Do a little bit at a time. You don't have to wait until you're 60. Start doing it.
You can, absolutely. So the point of everything is that, hey, if you are retired, you've got a lot of money in IRA, we can come up with plans to help you begin to do that, put together an idea, hey, money with a purpose. Once again, we can begin to take little bites out of it at a time to make some of your portfolio, some of your traditional IRA tax-free so that you can keep more of your money in your hands, in your family's hands, versus, like you always say, being in bed with Uncle Sam.
That's right.
Tax-free money is money that you have 100% control over because you know what the value of that money is. $100,000 of tax-free money's value is $100,000. $100,000 of taxable money's value is 80,
Yeah,
75,
TBD,
whatever. Right,
TBD,
you
right?
don't know.
To be determined, right?
So that is what you want to have, as much control as possible. And so there's hope, there's options, there's cool things, there's programs out there. So take advantage of those as much as we possibly can. Heather, something happens where you do a Roth conversion at 66. For some reason, you got to touch some of that money at 69. Whatever, what happens? I mean, I've been converting 15,000 a year. At 69 years old, I need to get $35,000. So I've been converting 15,000 for 4 years. What happens? What's the situation? What's my penalty? What's going on?
Well, in
And
that
that's
example, you would have a qualified distribution because you said you've been doing it for 15 years. So you've met the
Well, I
5
mean,
year.
I've been doing $15,000 of conversions a year for 4 years.
Oh, 4 years.
Started at
Okay. So we don't
65.
have the 5 years.
Don't
So we
have the five
don't have,
years.
yeah, we don't have the 5 years, but we do have the event. It's over 59 and a half. In that case, we don't have a qualifying event. So if you've got your basis, you've done 15,000 over 5 years. What is that? I can't think, 30,
Over 4 years,
45,000,
you got $60,000 in there over 4
$60,000.
years. Yeah.
So if you had to do that, the 60,000 is considered your basis, right? That comes out first. So you could get at it without a problem. You could get it. Not ideal, because then you're tapping into the basis that's then going to make the gain go down
Right.
conceivably, right? But you could. So, and contributions and conversions after 59 and a half, you always have access without any issues. Even if you don't have 5 years, you have access to it. Now, if you start doing conversions before 59 and a half, and let's say you do one at, say, 55, and 2 years later let's say you do a $15,000 conversion, you do it and then you say, I have an emergency, I need to get something out, I need to get 5,000 out, and I'm only 57, then you still can get that 15,000 is still basis and comes out first. So that 5,000 wouldn't be taxable again because it's already been paid tax on. But in that case, there's something called a recapture 5. And that says, hey, if you try to get at any of this basis or this converted amount, because you converted before 59 and a half, you're going to pay a 10% penalty on that 5,000 you took. That's a whole nother thing, which
Yeah.
confuses people, but you got to be careful. You got to, the point is you need to work with a knowledgeable financial professional that understands these rules to make sure that you're not set up for surprises at all. And obviously the idea of a Roth is let's do this and let's hold it. But yes, there are ways that you can get access to money usually. And certainly if you do everything after 59 and a half, then you're good. But if you start doing conversions before 59 and a half, and then you start trying to withdraw a conversion before 59 and a half, you might have a penalty problem, not tax problem necessarily.
Yeah. So
The most simplest concept is money with a purpose,
Yeah.
down the road money. For sure is the way to think about Roth and Roth conversions if you get to that retirement age. One last thing before we go, Mike, I want to ask Heather. Heather, I'm taking my Social Security. I'm 65 years old. I want to start doing Roth conversions. So we know that if you get a job,
Yeah,
you're
great
getting
question.
Social Security. Hey, I can lower my Social Security benefits because I'm working. If I do Roth conversions, does it affect my Social Security income?
So you got two different things going on. You're asking, does a Roth conversion count against what's called the earnings limit? When you take Social Security, you file for Social Security before your full retirement age, Social Security puts a limit on how much you can earn from wages, from gainful employment, right? That doesn't count because that's passive income. Will it cause a portion of your earnings and your Social Security to be taxable, or your earnings are taxable, but your Social Security to be taxable? Probably, but it's not going to count against you if you file an early claim for Social Security, you take a Roth conversion. If you're not working, you're fine. You're not going to get a withholding of any benefits because it's not earned income.
Right. So it is, if you got that opportunity and you have started Social Security early before full retirement, it's still a good idea to take advantage of those Roth conversions because it's not going to affect your Social Security income.
Right.
Wow.
Right. It's, tax wise, yes, a little bit, but as far as the income part,
earnings, it's not a problem there at all. And I do get that question a lot. What is counted as earned income when, if I take an early Social Security, can I convert? You can. That is not a problem. They're not going to withhold your benefits because it's not a W-2, it's not self-employment income, it's not wages, salaries, tips, that kind of thing.
Right.
What a series. What a series.
What a
Unbelievable.
series. So many options, so much great information. Heather Schreiber, thank you so much. I'm just going to W America's retirement tax expert because you are so knowledgeable and you're so kind to be here and to help us out. So, Johnnie, thank you for a great mini series. Everybody listening, go back and listen to all 4 of these, then reach out to Johnnie. Website's newheights.life. Ask for a copy of his best-selling book and see how he can help you answer a lot of these questions. Bring Heather and her team to the table to make sure that you're giving more money to yourself and your heirs than you are to Uncle Sam. Johnnie, Heather, thanks for a great, great mini series.
Thank you. It's great to
Thanks,
be here.
guys. Be blessed.